kind of not even give you, I just wanted to point out a couple of things, sorry, and this is really for the benefit of anyone who doesn't really know me and also anyone who's new to trading. Okay, so I'm based in the UK, I'm based in London, I trade regulated funds, but I went through the same, I think, learning process as a lot of people, and I've probably been trading professionally for about 5 or 6 years now. And so there's a couple of things I just thought I would kind of cover here. So there's a couple of, before we go to the markets, I just kind of want to lay a foundation here of thinking. There's a couple of critical areas and universal mistakes that I found when I'm speaking at certain events. I don't speak very often, it's 2 or 3 times a year. I'm actually trade for a living, that's my main kind of thing. But I notice when I'm discussing stuff with newer traders or traders who've been dabbling, and I say dabbling, for trading for a while, there's consistent areas where I think that they're probably, unbeknownst to them, are causing themselves pain and suffering. And a couple of those are, for example, just trading only one market. So they'll wake up and go, euro dollar's my market, that's what I'm focusing on, or the DAX, and that's the only thing I trade. And the logic and reasoning behind that never really kind of caught on to me. I think sometimes there'll be reasons that they have for that. But the problem with that is that the market conditions will vary from day to day. And if they're not aware of that, they'll probably be trading every day, no matter whether the conditions are suitable or not. Trading too low a time frame. This is a big one. For some reason, newer traders are very much attracted to the speed and the excitement of the lower time frames, but it comes with massive volatility and increased spread to risk or to position sizing ratios. And so if I could go back in time and tell myself one thing when I got started was, Adam, focus on the 4-hour and daily initially, where it's less volatile, while you master your strategies, build up your confidence. You're going to make the same amount of money anyway. You might not trade as much, but you'll have fewer losing trades because of the volatility. Not mastering one strategy at a time, so jumping between the cool, shiny strategies was a big problem. This is a big one. This kills everyone, and it's hard for them to understand this. We don't really need to know as traders, we're not investors. We don't need to know why the market is doing what it's doing. This is crucial. We don't need to know that. It's completely irrelevant. You think you need it because we humans love to attach meaning to things. I don't know, we like to do it. But listening to the news, reading the news, please remember that 30 years ago, we got a newspaper once a day, and actually closer to 50 years ago, yikes. And we could see the news on TV once or twice a day. That was it. So the news is not a big cog, as big a cog in the movements of the market as people think it is. But it does create a bias. It creates this belief in our head that Brexit is going to make the market crash, or the dollar's going to do this, or trade wars are going to do this. And then we are out of sync with what the market is doing today. As traders, I'm only concerned with what are the market conditions today and this week. In my near future, what are the money-making opportunities, not why. So just be aware of that. Just be aware of that. Subscribing to obviously too much content leads to analysis paralysis. 10 different traders looking at the same chart should agree on what the market conditions are, what the trend is or no trend. If they're disagreeing, somebody's wrong, because market conditions are what they are. It's either trending up, trending down, or it's not trending at all. Whether they would trade it and take a counter trend trade, or you can have traders trading in both directions in this, but both of them will at least acknowledge what the market conditions are. And trading high impact news events is not something professionals do, because that is much closer to gambling. We can't predict how the market will react to certain things, even if we think we can. Even if we have the numbers ahead of time, the market can react adversely against it. And I found a lot of people scratching their heads, frustrated that they were certain that the market would react one way when it reacts another, and that's what confuses them. So those are the kind of things that we want to avoid. We're evidence-based trading, technical traders. We look to build a case to take a trade example. Most important, we need to know what is the daily doing. It should be trending. If we trade in line with the daily trend, we have a 70% chance of making money. If we trade against the daily trend, 60%, or if there's no trend, there's a 60 to 70% chance we'll lose money. So just be aware of that. I'm just jumping through these. So to give you an idea, when I talk about market conditions being crucial, it doesn't matter what the instrument is that we're trading. If there's no clear trend, all right, there's no rational behavior. The market is just bobbing around. It's ebb and flows all over the place. It's too choppy. And if we participate in that, that is, we're going to more than likely lose money. And we also won't know why we're winning. Then we can get potential trades where the market now has a given direction. All right. So actually, all of these constitute decent trends. All of these 4 charts on the right. The bottom one as well, just saying there's no momentum here. So when we talk about volatility in the markets, it actually has 2 different applications. Volatility meaning, in a good way, meaning movement. The market's moving, therefore there's some volatility, we need that. If the market's flat, there's no volatility at all. And then of course there's, I guess, undue or extreme volatility, which means it's too choppy looks like this, we should get out of it. Okay, so this is good volatility, this is bad volatility. Think of it as weather conditions. If it's too stormy, or there's nothing happening, or if there is at least something happening. And again, I don't need to know what this is, and I don't need to know why it's trending, but I do need to be able to identify conditions where the market's going in one direction is highly likely. Just by picking the right market conditions right off the bat, I have a very good chance of making money. It's not guaranteed, but it's very good. And also just things, these are examples of unhelpful media context. When I mentioned earlier when I mentioned earlier that it can mess with us, stuff like this sounds like it's called word salad. It just gives us what we think is important information that is of actual no use to traders. So please understand that traders, investors, brokers, salespeople, marketing people all exist within the same industry. And so the content you get doesn't necessarily come from a trader. And so this, for example, immediately tells me that this kind of content, these are not professional traders. These are either analysts, or they are kind of providing you with a covering their ass kind of analysis of the market could do anything approach. And these are not real traders, or they're not trading for a living. Whereas, and also comments like this, this doesn't really help us per se. It gives us a bias, makes us think gold or oil is going to go up. So this is where I'm just giving examples of things that will mess with you. If you're a newer trader, will actually mess with your performance. There we go. So that being said, let's go across to the charts and have a look at the market conditions. I'm using, if anyone cares, I use MT4. I used to use eSignal. I've used TradeStation in the past. I'm setting on Pro Real Time. Why do I use Pro Real Time? This TradingView, obviously TradingView is great. I prefer Pro Real Time mainly because my favorite charting package to date was eSignal, and this is the closest to that. It's fast, obviously, but it's just my personal preference. I like it. It's customizable. TradingView would be my second choice, most likely, and then MT4. I started with a lot of charts here because as a beginner trader, you're going to want to be able to break price down from the lower time frames. You need to see the flow of it to the higher time frames, and your brain does not know how to extrapolate from a little bit of information. So you need more charts that slice up the higher time frames, all the different time frames, so that your brain can learn to connect from the lower time frames to the higher time frames. So for example, there's no clear trend going on right now. As I go up the time frame, it's still messy here. In fact, it's still messy here, but it's leaning at least to the upside. There's a level of support and resistance here. It's also found resistance immediately. And if I look at it on the daily, I can also see there's no clear direction. How do I know that? Well, it was in an uptrend with higher lows and higher highs. It then produced a lower high and a lower low, and now it's produced a new high. So it's bobbing between different values. So what does that mean? Well, if I'm looking at it, if it is producing a series of high lows, high highs, it's an uptrend, lower highs, lower lows, it's a downtrend, and then I'm looking only to sell with that. So trends attract big money and professional traders who behave in a more rational, orderly fashion. So when I trade in the same direction as a trend, I'm actually trading with the big money. I don't have to worry about the market it's not messing with me. If I decide I want to go down in an uptrend, I want to sell, then I'm just going against the flow. If the market, on the other hand, is mixing up its highs and lows, so it kind of does this and then creates a fresh low, then a fresh high, and it's doing this, there's no trend, and these are money losing conditions. So these are the kind of conditions I need to assess and avoid and stay away from. And most people don't, nobody tells them that, and nobody seems to kind of appreciate that. So when I look at the markets here, that's actually what it's doing here. The lows right now are mixed, there is no clear direction. And so really the market doesn't really know what it wants to do. So the problem with that is that it's the same with most of the US markets at the moment. All right. If I go through to NASDAQ, which is the most bullish of the bunch, that is now in an uptrend. There's an uptrend happening here. High lows, high highs. There's an uptrend happening on the 30 minutes. There's actually a downtrend happening on the 1 hour, but as soon as I go up to the 4 hour, there's an uptrend. And this is a potential trading opportunity. So if you look, the structure here is good. The daily is also in an uptrend. It's a little bit far away from the moving averages, but it's not, compared to previous cycles, it's not that far away. And it's setting up right now with a potential trading opportunity. So the way in which I do this is I have an uptrend in principle on the daily, uptrend on the 4 hour. I also have an uptrend on the lower time frames, but this is an actual setup that's occurring right now. If I place my entry above the high of this little indecision candle and my stop loss below the low, there's a potential to take that if price then subsequently follows through and heads up. What I also want to do obviously is protect myself. So I'm not going to risk more than 1%, maybe 0.5% or less on this. And I'm absolutely going to take profit off when I get to 1-to-1. So probably as I approach this distance here, around about this level, I'll take some profit off the table. That way that if price can't get past this level, if it now encounters 9,500 is a nice round number. If it encounters resistance there, I will at least be break even my trade. So what I've done at that point is identify a high probability setup and at the same time assessed what the risk is. So that is the best of the setups on the indices at the moment, and it is the best time frame right now. Yes, that level is up here, so I could consider the idea of taking a trade, a similar type of pattern between here and here on the 5 minutes or 15 minutes if it trends up and down. So you can see there's a level of support and resistance here. There, if I just put that in somewhere around here, give me a second. There. So what I could do if I go down to say 15 minutes is I also need to be aware where is that level, that 95 level here, which is over there. Just put that in. This is my safe operating area before I encounter big resistance. So one potential trade on the lower time frame would be this. So I would look, I'm just going to draw it in, looking for price. Here's my uptrend, broken through a level of resistance, coming back to test it for support. If it produces a nice bullish candle like this, nice green little candle, put my entry above the high, my stop loss below the low. My stop loss below the low is amazing because it has the additional technical protection of this level. It's a little extra, it's a bonus extra. Then the potential profit is up to about here. I probably want to exit before I get to that level and absolutely take profit as I go. So again, 1-to-1. So that would be, depending on the size of the candle and its location, that is going to be a 3-to-1 or 4-to-1 trade setup. Potential profit. But I would be stupid to think it's going to successfully break through that level. I could take the trade on the 4-hourly or on the lower time frame. But I'm just explaining to you that I want you to get a sense of what is the reasoning, why would I take the trade? Okay, and none of it has to do with anything other, I'm not concerned with economics at all. Economists make the worst traders. They don't know what they're doing. As traders, at any rate, they might be good investors. And the only person I trust would be Warren Buffett. So that is the reasoning behind taking that trade. Let me have a look and see what your questions are. Okay, thanks. Okay, so there's a nice little move up to that. Simon, can you just tell me how long do you want me to go until? Because there's quite a bit I can go through and have a look at, and I just want to make sure I've got an eye on the time.
It was just a quick slot until 12:30. Fred is
7 minutes
to speak 12:30 to 1. So
if
you can answer thanks.
Cool. I've only got, there are no questions for me. So there are no other questions unless you've seen one.
Well, let's have a look at the trade you were talking about, and in the meantime, if anybody has a particular trade they want to Adam's feedback on, just use the chat box in the next couple of minutes, and then
that's fine.
We can
you can see, and the market's quite bullish here, so it looks good. It's fine. I'm happy with that. I've identified where my potential brick wall is that I'm going to run into. This is a healthy trend. The structure of this trend is the clue. The behavior of a stable trend is in its own way stable. In other words, it's more likely to behave in a predictable manner because of its very stability. Because of its yeah, I think that's the right language. Anyway, so that's to cover that. Well, let's go and look through a few others. So if we compare that to say FTSE, for example, now you can even see here, for example, prices come back, bounced off the 6,000 level, sorry, and is looking to carry on. But if I have to choose, I'm picking one particular chart over that, and the US tech, the NASDAQ is the most bullish index in the world right now. It's technologies, it's US technologies. If some of the other markets are wobbling, that one isn't. And I'm not presuming, by the way, that it's gonna not, head lower tomorrow or next week. I'm looking at a valid setup for the next few hours. So my rationale is based on identifying the risks for this trade setup within this window. So let's go and have a look at some of the other currency pairs. Let's go look at the US dollar. So how's the US dollar today? What is going on with the US dollar today? The US dollar today is range bound on the daily. So here's my daily chart to the bottom, 4 hours, 1 hour, 30 minutes, 15 minutes. It's range bound. It is heading lower. There is a level down here. It's trending on the 30 minutes. It's messy on the 1 hour. It's trending lower on the 4 hours. So there was a nice little trade set up potentially. It's heading down to about this level. It's going to hit a bit of a brick wall there. I could do the same thing on the lower time frame. So going to the 5 minutes, there would be potential pullbacks into this. But not everyone has access to the dollar basket. It's not a big deal. Let's go to the euro, which is the inverse correlation of that. So euro dollar is generally the inverse correlation of that. And actually, isn't that interesting? Euro dollar is coming up to 11,001.1. That's the top of its range. It's had a straight move all the way up. What are the odds of it being rejected after a long run up? It's high. It is keen to break through that level, but there's a 50-50 chance at this point in time that it might take a knock. So there's no trading opportunity right now. We're already at the key level. I have to wait for price to either break through the level, pull back and test it and take it, or I've got to, but there's nothing there right now. Cable. So sterling is actually a little bit more bearish. It's a downtrend on the daily. So there's a couple of sterling pairs because we've got 4 minutes left. I'll show you. I really like, for example, let's have a look at some of these pairs. So pound Aussie's got a really nice daily downtrend. It's pulled back. There's my 4 hour. There's a nice little bearish candle. Wait for that to close. I've got 3 hours, 3.5 hours for that to close. One approach is to put my entry below the low of that closed candle in 3 hours time, my stop loss above the high. So I'm basically depending on this cycle continuing, and the general structure of the charts is nice and stable. So I'm depending on the idea that I would enter below the low of this closed candle with my stop loss above the high, and then look to take profit. Again, we've gone from an uptrend back into a downtrend because we were in a temporary uptrend here. We're heading lower. So once we break below the low of this closed candle, which could be somewhere in this area, then I would consider taking time frames. So notice how I'm looking at trade setups on the 4 hour for now and the 5 minutes, those lower time frames. But the decision to trade them is based off the quality of the daily setup. So pound Aussie and GBP pairs are generally looking more bearish than bullish. Look at that. Pound QB is heading lower. There's a setup also potentially occurring there. Pound Aussie is better of the two for me, prefer it. You can see pound yen is also in a downtrend, but the retracements are quite deep. So it's got a greater mix of buyers and sellers, of buyers in that relationship there. Pound Swissy is also heading a bit low. So most of the GBP pairs are heading a little bit low. Those are my favorites there. Gold, because we've got 2 minutes left. Gold is, so gold, the problem with gold at the moment is it's obviously close to 1750. It's encountering a bit of resistance there. And there's no real opportunities just yet on that. Silver is very overextended. So silver's properly overextended on the daily. It has to come back down. And therefore, there's no trading opportunities on silver for now. Would I trade it on the way down? It's higher risk because the trend is actually up. And it could come down to this pivot level or to the moving averages and turn around here. It could come all the way back down to this level of resistance and turn here. It's higher risk. I could trade it on the 5 minutes, but I would be quick to take profits. And I would not get upset if it went down to these areas and then turn around and went up before I could take profits, because I've accepted that the risk is higher because this is an uptrending asset. Oil as a similar, these are really good. These are beautiful uptrends at the moment. It's encountering some resistance on the 5 minutes. It's running into a bit of a brick wall here, but overall it's pretty good. I would say that the 4 hour needs to take a bit of a breather, come back down to here, and then there could be another run up. And then the last one, Bitcoin, is hitting strong resistance at 10,000. At this point, there's no trading opportunities here. It has to break up above that or head lower, but there's nothing at this point in time. It's stuck in that area. So let me have a look. Let's see your questions. Cool. You're most welcome. So I looked at cable. That's good. Am I using IG markets? I am. I'm a big fan of Interactive Brokers, Axie Trader. Finico Bank is a good platform, is a good account as well because it's backed by bank. Ducos Copy, there's quite a few decent ones out there, but I like using Pro Realtime. So because of Pro Realtime, I have an account with IG Index and Interactive Brokers. This is the IG Index account. And the reason I have those accounts, sorry, I'm not pitching them, I'm explaining that the reason I have them is because I have access to other markets. I want commodities and I want stocks and things as well. I don't just want currencies and indices. Those are acceptable, but for me, I'm doing investing as well as trading. Can I please just say the charting package? It's called Pro Real Time. So it's up here, the name is up there. It's called Pro Real Time. They are a third-party package, but you can get them access to them for free through Interactive Brokers or IG Index. That's for you. I don't get any benefit. You can sign up for that. You don't have to mention my name. It doesn't mean anything. So where do you learn strategies and setups? Simon is the answer for that. Simon will usually collaborate with me to have sessions where we talk about a strategy. And I'm pretty much, in most of my activities, Simon, I think I'm pretty much exclusive to you. So that's my time that we do that. I do have a YouTube channel called Trade All Markets. If you want to go to that, you can. That one is on YouTube somewhere. Find me on LinkedIn as well. But Trade All Markets is my YouTube channel. There's some content there as well that I put up, like scans that I did this morning. Is there a sense to trade both ways on constant oscillation? So you could counter trend trade, you could trade a range, you could trade trends. I've done them all. It's my personal opinion here, I have decided to settle on just trading trends. It's less stressful, it's more profitable, and more importantly, I'm not trying to squeeze a trade out of every chart, because then I spend 30 minutes looking at every single chart, trying to determine if there's a trade I can squeeze out of it. It's either trending or not trending. If it's trending, then I know, okay, I should be focusing on it. So I find that I take fewer trades, but I'm looking for 2 to 5 trades per week minimum, and I stress less. So I love it. That's a personal point of happiness, though. So the answer I would say from experience would be I'm happier with just trend trading. Thank you, Adam. First time I heard about only trading good trending charts. Exactly. And I don't know why they don't say it, but market conditions are the key thing. And the YouTube link is, if you just go search for Trade All Markets with a Z, you should find me there. Simon, thank you, ladies and gents. I love the questions, by the way. Those are good questions. And look, I'm always around. Simon will include me as often as you can.
I can indeed. Well, never is the phrase leave them wanting more, be more appropriate. Adam, thank you very much for coming in and doing a rapid fire session for us. I appreciate it. I know you had a busy day and you fitted us in at late notice, so thank you for that. Great feedback as well. So I will take back the presenter role. As I say, we'll keep you up to date. We do various events together, Adam and I, with Fineco Bank and just on ourselves as well. So as and when we'll plan out whether them. There is an event coming up 27th of May that we're doing with Fineco as well. So I'll keep you aware of that on the email. Adam, thanks so much again for joining us. I'm going to take back the presenter room now, and we'll move along, but really appreciate that. Thank you.
You're most welcome. Thank you, ladies and gents. Have a good week and stay safe. Thank you.
Thank you to Adam Harris there. Right, okay, welcome to everybody that's just joined in the last half an hour. You've just heard Adam Harris opening up our 2-hour working lunch event today. My name's Simon Campbell. This is a round-the-clock trader event, and we're listening to 3 experts today. We've just heard Adam Harris. We are about to go over to Fred Brett at Global Commodity Investments Limited, and we're going to be talking about gold, specifically in the next 20 to 30 minutes. Then we're going over at 1 o'clock to David Bell, founder of macrodesiac.com. David's got some great information for us on how to use the macroeconomic signals to keep our trades in the right position, so we're ready for the shocks. A slow one from Adam next time, says Philip. Yes, rapid fire. This is the key. We want to try and keep these sessions quite quick so we can keep the attention. Let's go across now and take the microphone off Fred, and we can say good afternoon, see if we can hear Fred okay. You should be able to speak.
Hello.
Hello, yes.
Hi, Simon.
Fred, it's Simon here. How are you?
Yeah, I'm good, you?
I'm very well, thank you. Thank you. I think I can hear you loud and clear. Super to have you here. Yeah, Fred, you and I knew each other many years ago. It's a tribute to LinkedIn platform, is that we can kind of keep in touch, and we can keep in touch and get you back on to talk about things like gold investing. I think the last time we met was in the Hilton Hotel at the 4th Row Bridge way back in 2012. So it's been a while.
Yep, that's right.
I remember a rainy day, and I subsequently went over the bridge up to Ely, where the sun was shining, But it's just great. I love being able to keep in touch with people like this. Otherwise, we would have lost the connection. Fred, we're looking at gold. We haven't really done a presentation on gold for a while, and when I thought, who do I get to talk about gold, your name was the first that popped into my head, because you've been in the gold market for a long time with global commodity investments. Shall we screen share? Do you have something on your screen that we want to look at?
I've got a PowerPoint I'd like to share.
Fantastic. Okay, well then let's do the screen share, which now you will have a button that should make you wonderful. You're wonderful. Yeah. Okay. So
You got it, yeah?
we've got that. So if you maximize that into presentation mode, we'll be able to see that full screen. So yeah, we're essentially we're an audience of traders here, but we also have investment portfolios as well. So I'm just interested because gold has been on everybody's lips for the last few while. It's been up or it's down again. There's Adam saying, well, you know, maybe have we missed the boat with gold, or where are we? So I thought we'd ask you to come join us.
Well, the first thing with gold at the present moment is obviously we have the coronavirus situation. We have the massive funding that's going into the system from all countries worldwide, which is obviously creating a major problem in the financial markets. Gold, safe haven, asset class, gold is money. We've heard it all before. My feeling and my belief is, I've always said it to people, it's not the price you buy gold at, it's the fact that you actually bought it that will protect you. It's not a short-term investment. It's not like Adam's investments where you're looking at 5 minutes, 10 minutes. I always say with gold, try and look at a 5 or a 10-year plan minimum, because it should, and certainly with the current climate, return a reasonable, if not a decent return. Gold is the best performing asset of 2020 so far. And as I say, with the coronavirus, with China, America, with all these things that are going on, you can only see it one way. But with every market, people will take profits. You are seeing a bit of a dip in the market today. Gold's hit a record high 2 days in a row. Today, it's going to come down, the same as the other metals. It's not just gold we do gold, silver, platinum, and palladium. Just very quickly on palladium, with the development of hybrid cars, palladium is performing extremely, extremely well and could go an awful lot higher as well. So that's something, just as an aside, to keep your eye on.
Yeah, for sure. It's fascinating. Can I ask you just to maximize, because I'm looking at the slide, but I'm looking at within the PowerPoint platform. So if there's a presentation, there's a little bit just bottom right that looks like a screen, a flip chart screen. If you just along to the right from there, you'll see some buttons. Just literally move to the cursor along to the right. The other way.
Other way, right? Okay.
Just so there's just a little bit there. There's what you call a flip chart, like a screen, projector screen. If you hit that,
slideshow,
and that's right. That will bring it into full screen, which will be easier for us to see.
Okay.
And then we can read the slides.
There we go.
Oh, wonderful! Thank you. Okay, so a gold income plan.
Yeah, I have tried to develop different alternatives, if you like, for people to be able to invest into the markets. I mean, just as I've been doing this since 2001, 19 years for God's sake. Still love it, still want to do it, still want to go to work every morning, although I can't just now. I'm stuck at home, same as everybody else probably. But the gold income plan was devised from the fact that I speak to so many people who say doesn't do anything. It's just a bit of metal, doesn't pay me any money. Well, okay, so basically a lot of people are just looking for an annual income rather than looking at the fact that gold goes up on average by 20% a year. On average, over 45 years, they're going up by 25% a year. So I looked at how we could possibly introduce something which does pay people an income, and that's where the gold income plan came from. It's a 5-year plan with the first 3 years guaranteeing a minimum 6.5% per annum. Every investment is backed 100% by the physical bullion. The final 2 years, it gives you a variable income. So if gold goes up by 15%, it's the client's choice if they take 15% or 10% or whatever they want to do. Obviously, you have the potential for capital growth as well. So that, to me, was one way of getting something across that people could look at and say, well, you know what? In this day and age, 6.5% guaranteed is a reasonable income. And the fact it's backed by gold gives it that little bit of security. At the end of the 5-year term, you have a choice. You roll it over or you sell it out. It's up to the client at the end of the day. So that's why we have the gold income plan. We have various other plans, the accumulator, the gold silver accumulators. I've had to do this at short notice because I only managed to sort of accept this yesterday, so forgive the quality. The gold and silver accumulators allow, again, people think you need 50,000 or 100,000 to buy into the precious metals market. Those days are long gone. So from £150 a month, we will buy physical bullion and the client builds up a portfolio for a period of time. It's a 12-month rolling contract unless they want to cancel. So for £150 a month or £600 a year, whatever it is, you can actually build up a portfolio rather than saying, I need 5 grand, 10 grand, 50 grand, whatever it may be. Again, if someone says, well, I can only afford £100 a month, we'll do it £100 a month. We're trying to get as many people to understand the benefits of having gold in their investment portfolio. This is just a little bit of an add-on onto the accumulators. Everything's 100% backed. Everything we do is 100%. Oh, sorry, just got too far. It's 100% backed by physical bullion. We don't do paper trading. We don't do anything like that. I don't know how to get back one. So,
just press the up arrow or the left. Or the
oh,
left
there you
arrow.
go. Thank you.
Yeah.
Okay. Very basic. Look, your whole, it's not backed by your derivatives. There's no counterparty risk or anything like that. You can invest, as I say, from £100 nowadays. You have the option of investing lump sums. So if somebody wins 50 grand on the lottery, they want to put 25 grand into their investment, they can do that. So it's just, again, a low cost way of encouraging people to buy into the markets. You can also do it for your kids. You can save over a period of time for your kids and survive 7 years to get around the inheritance tax situation. So there's various benefits in doing it. We obviously, our main market is actual physical gold bullion. We firmly believe that everyone should have some in their portfolio. It's their diversification, it's their safety net. You wouldn't build your house on sand. Don't build your investment portfolio on the same thing. Give it a solid base. I'm not sure if everyone knows. I know Simon is probably aware and does know the fact of what drives the markets. It's uncertainty, and at the present moment, we've got to agree that we have major uncertainty in the markets. We're pumping so much money into the markets. The UK with the coronavirus are giving loans, grants. It's all going to have to be paid back at some stage. So what you'll probably find is people will turn to gold. It's a preservation of purchasing power. It's never been worthless, ever. Asset allocation, not over the top, between 8 to 12%. You could probably at the present moment squeeze that to 20 if you wanted to. But you know, the sort of general consensus in the market is between 8 and 12%. I don't think that's over the top, to be perfectly honest myself. I think it's a reasonable amount. But as I say, if someone wanted to put more in, then they can obviously do that. It depends on your outlook to the gold market, because as I say, you're actually holding physical bullion. It's sitting in a vault doing nothing. We dig gold out the ground, we bury it again, and that's what we do. Very few people take delivery of gold because they don't want it in their house. It's not safe to keep it in house, and it's quite expensive to insure. So that's it, as I say, is our main area is physical gold bullion. Non-recourse leverage, this is for the higher end. This is a high risk. Again, you've got to try and have a product for everyone. So we have a lot of people who margin trade in the markets. There's no doubt about it. The margin trade, that they can go into deficit on their accounts on certain trades. We allow a client to control up to 4 times the commodity that they would buy on an outright purchase. The difference is, ours is called non-recourse. So if you buy and the market crashes and you go into deficit, the deficit's our problem, never the client's. On the flip side, if the market does what we expect it to do, then the client will take 4 times as much profit on the upside. So it gives them the upside with no downside. You can't lose more than you put in, and no one ever has lost more than they've put into the market. Yes, people have lost because that's the way the market is. But this, as I say, is extremely high risk. It is not suitable for everybody. 10 bullet points on why you should buy physical gold. Again, I think these are pretty simple, straightforward. Gold's always been money. It's outlasted every fiat currency of the world. Every reserve currency of the world has crashed at some stage. It's a tangible asset. It's physical. It's not paper. Can't be hacked. Can't be erased. You can't just print it. You've got to dig it out. There's no counterparty risk with gold. And every single bar of gold we buy is held in the client's name. We never hold any. It's stored, it's insured by Lloyd's of London from the second we buy it till the second we sell it. So it's always safe from that point of view. You'll never, if we're shipping it from one place to another and the ship sinks, then we're all right, we're covered. It can be a private form of wealth. Nobody needs to know you've got it. You know, it's not something you want to go down the pub and talk about. So it's liquid and portable, so you can take it anywhere. It's liquid 24 hours a day, 7 days a week. I could buy gold in 2 minutes and I can sell it in 2 minutes. So clients can have their money back within 24, 48 hours. The storage costs are extremely low. In some cases, depending on what people buy, we don't charge for storage, and we don't charge for insurance either. So, and we don't charge for transportation from the mine, because we buy directly from the mine to the facility that we use, which is Brinks. And Brinks are well known in the storage industry as one of the best. You don't need any special skills. You really don't. There's only a couple of things that drive the market. That's geopolitical and financial. That's it. Obviously, you do have the situation where you have supply and demand, but at the present moment, very little supply and extremely high demand, where at the moment you're struggling to get certain bars because we can't get them delivered. Our advice is, if you are storing gold, store it outside the UK, store it in Singapore. It's the safest jurisdiction in the world. It's financially secure and it's geopolitically secure. There's no real hassles there. And it's, again, got one of the best names for the storage, which is why we use Brinks in Singapore rather than Brinks in London. It's a hedge against the stock market and everything else that's going on. If the stock market crashes, gold will tend to go in the opposite direction, but it will also sometimes fall at the same time, because people will sell whatever they can to keep a stock or an equity in the market if they have a margin call. So it works 2 ways. It protects you in one way and will go up, and it also protects you on the downside, but you've got to accept the fact that sometimes it will fall because of what's happening in the equity market and people getting margin calls. It doesn't tend to fall massively. And when it does fall, it tends to recover quite quickly. We have multiple risk on all fronts at the present moment. And I think everybody will be aware because we're all probably sitting at home just now. I know for a fact, I mean, I can't go to our office because our office is completely closed. I'll go down the street and it's like deserted. So this is a time when gold will actually protect anyone that's looking to hold it. This is our contact details. Again, I've had to do this at very short notice. If I do another one in the future, it'll be a lot better. The website, obviously, my email address, the office number, the mobile number. We have an office in Nottingham as well. Again, we're on Twitter, LinkedIn, Facebook, all them. So they're all, you know, listed there, and or certainly on the website anyway. So I don't really think I could say much more than that, to be perfectly honest.
Fred, that's great. It's a great reminder, and it was short notice. I think it might have only been yesterday, even though
Yeah.
I dropped you in it. Can you come and speak about gold? So I appreciate that. I mean, lots of things. Obviously, anybody wants to get in touch with Fred, you just can come through me. If you haven't been able to scribble down the contact details, just drop me an email and I'll put you straight in touch with Fred. But it is fascinating. I think it was Fred. I think it was your stand where we had a show in London.
Yeah.
And you brought along a bar of gold onto the stand. And my God, if you've never held a bar of gold, it's an incredible thing because it is so blooming heavy. It's incredible for the size of it. And I once heard a statistic that all the gold in the world would only fill about 5 Olympic swimming pools or something along these lines. So
all the gold in the world would fit in one Olympic swimming pool.
Just one. Well, you see, there we
Just
are.
one,
So it's
yeah.
it's that limited supply.
Yeah.
And it's a fascinating investment, and it does sound like something for long term. Doesn't seem any reason why not. It's resistant to a lot of these shocks, so that's why it's a good, important one. Can one buy platinum and palladium bars? Marguerite is asking.
Sorry?
Can you buy platinum and palladium bars?
Yes. Yes. We do. We don't do coins for platinum and palladium. The main usage for platinum and palladium are catalytic converters in the car industry and lorry industry. But recently, as I say, with the development of hybrid cars, palladium in particular is the main metal for the hybrid cars, and palladium has pretty much flowing through the roof. It will pull down today because it went up. I think over the last 3 days, it's gone up by nearly $300. So at that level, you're going to see it pulling back. But yes, we could buy platinum and palladium. We do gold, silver, bars and coins, platinum and palladium bars.
And I've also seen websites where we're looking at sort of crypto exposure to gold, but it's backed up by gold and things like that. Is that something you know about?
Simon, oh dear. I'm in the middle, and I'm involved, very deeply involved, in a cryptocurrency called TPX Gold. Okay. It's a cryptocurrency. It's a token which is backed 100% by physical bullion.
Ah, okay. Yeah, this is the sort of thing I think I've seen a few bits of information. Maybe it was TPX or something else, but I just thought I'd ask you because it's something that's come across my desk a couple of times.
I can certainly talk to you about TPX.
Yeah.
I can send you some information, Simon. It's not a problem.
Let's save that maybe for another one, another time, to get, because it's just these different ways to get exposure to the gold market that's making it more exciting as well, maybe more accessible and more tradable, which is something that we're all interested in. Ken says the message here is you are safer if you're a long-term in your outlook. As investors leave equities and run to the hills due to COVID-19, have these short-term gains been realized, i.e. there is no further upside expected in the immediate future? Yeah, you might be right, Ken. I don't know if Fred, you think it's better to take a long-term outlook?
I always say 5 to 10 years, but you've got to be realistic. We have a crisis that is unknown. We've never gone through it, and hopefully to God we never go through it again. We've lost so many people worldwide, and we're going to lose more on the going forward. If gold goes up by $300 or $400, we work on an advisory basis. I believe we're the only commodity broker in the United Kingdom that will give clients advice of the best time to buy and also the best time to sell. So if someone's holding gold and they bought it at $700, well, $900 or $1,000, and it's sitting at $1,400 or $1,500, and it's gone up quite quickly, we'll pick up the phone and say, look, your choice, what do you want to do? You can take 42%. If the market dips, we can go back in again, or you can leave it. What do you want to do? And if the client says, let's sell it, then, or sell half it, or whatever they want to do, we'll do what they want to do. But you don't just buy gold from us and then we forget about you. If you buy gold or silver, platinum, palladium for us, we will keep in touch. We will give you market updates. We'll tell you what the market's doing. We'll tell you where you sit. And if, again, as I say, if we feel the market's gone up very, very quickly, the chances are it's going to fall just as quick. So again, you can put in a limit sell order. If it hits $1,500, I want it sold. So we stick a sell order in place, and if it hits $1,500, it's automatically sold out the market. So yeah, we will talk to our clients. We're not, everybody probably knows bullion buy post. We're not bullion buy post. You order online, they stick it out to you and never talk to you again. And regardless of how much you order from them, we're the opposite side of the scale. We will talk to our clients, and we talk to them on a regular basis.
Well, absolutely. I mean, Fred, you've been in the business a long time, 19 years. As I say, we've known each other. Many of that we haven't talked for a few years, so well,
no.
It's nice to put that little wrong right. Great to be in touch, and
yeah.
you know, thank you for coming and joining us. I know it was a short notice thing, but I appreciate you taking the time to put a few slides together and bring us up to date, and just open our eyes to some of the options that are available when it comes to buying gold. You don't need a fortune. You can tiptoe in with a regular subscription, a regular almost a sort of a direct debit, I guess, to tiptoe into the market. So Fred's your man to help you. And Global Commodity Investments, the website's gcil.co.uk.
Yeah.
But anybody interested to get in touch with Fred, please just drop me a line, email, return any of the emails that I send you, and that'll get straight to me, and I can forward that on to Fred, who will call you back, and you can have a chat about that. So Fred, thank you so much indeed for coming and joining us today. It's been great to have you tell us a bit about gold. I'll take the presenter role back from you now, so that
thank you. Cheers, Nyron.
Thank you again. Bye-bye for now.
Thank you. Bye.
Fantastic, Fred Brett, for gold. For anybody that's interested, as I say, just get in touch with me. Okay, welcome. For those of you, I can still see people logging in now, which has been great. And no doubt some of you are coming specifically on to hear David Bell, who's going to be joining us in just a second or two. So welcome to the show, Round the Clock Trader. This is the working lunch every Thursday, 2 hours. We feature 1, 2, or sometimes 3 different speakers and traders to look at the markets and to give us some guidance on what's going on. My name's Simon Campbell. We've already had Adam Harris with us looking at the Forex markets. We've just heard Fred Brett giving us a little bit update on how to get exposure to gold. And now I'm pleased to say that David Bell is here to join us. David wears 2 hats. One hat is the UK Growth Director for TradingView, which of course we've all heard of, and most of us you will be using on a regular basis. So David's growing TradingView in the UK, but He's also launched macrodesiac.com, which is an interesting service, and it's there to, well, David will tell us what it's there to do, but it caught my attention. I thought this is interesting. We haven't featured anything like this before on any of our events, and I'm not sure if it's widely available as a tool for investors and traders. So you might want to switch off any distractions and give David some time now, because I think you'll be interested in this. I've taken the microphone off. David Bell, welcome to our show.
Hello.
You should be able to speak.
Hello, mate. How are you doing?
Very well, thank you. Very well, great. You're coming through nice and loud and clear, so a great microphone which is there. So yeah, just rambling away, saying that we're excited to hear about macrodesiac.com. I know it's a new service you've launched. We've been in touch as well, wearing your TradingView hats, because we're going to hopefully launch some events where we can stream them through the TradingView website and things like that. We've got all these plans coming up in the future. But the macrodesiac service, which I've been following you on your LinkedIn post, is exciting, because we haven't seen anything like this specifically tailored for retail markets, and I'm excited for you to tell us a bit more about it. So can we share screens?
Yes. Do I have to press something, or let me just check.
You should get a prompt now, which will
Right,
allow you to share. Great. Why the hell are stocks rallying? Yes, we're looking at that. We're looking at the TradingView screen. Just to double check before we get started, everybody here, can you just use the chat box to let us know that you can see now the TradingView screen, the charts on David's screen? If you just use the chat box, fantastic. Okay, so we're coming through loud and clear, and then we're all looking at the right screen. So, okay, so where should we start, David?
Well, firstly, I mean, I was going to talk. It's pretty obvious what I was going to talk about initially. Why the hell are stocks rallying? But I'll give a little intro to Macrodesiac. So I set up Macrodesiac because I thought that the macro landscape just ends up being too jargonistic, and you're hit with so many different bits of information that if you're kind of more of a novice investor, a novice trader, even intermediate traders, you just sometimes just get lost in kind of all of the words and all of the concepts that aren't really explained very clearly. I think it's very presumptuous for a lot of these analysts and writers to presume that people know what they're kind of talking about, you know. So I set it up purely to be a guidance tool for retail traders. Now we've got about 500 or 600 people in the community. Just launched an app last week, and just really looking to grow it and really improve the knowledge of the general retail trading population in the macro sphere. By the way, I might talk about some higher brow concepts here, and there might be some terms that people haven't necessarily heard before. So Simon, if you do think I'm verging onto being a little bit too high brow, then just interrupt me and say, can you explain that again? Is that all right?
We'll go, but in fact, I think I can probably already say the majority of us here are in the markets already, and we've got probably an above average understanding of some of the concepts and the jargon. But by all means, if you get too complex, I'll say whoa.
Yeah, exactly.
Back up a bit. But just to give you that understanding, so I know you haven't spoken to our audience before. We are active traders in the markets. We do these sort of webinars frequently, so we should be able to keep up. But we'll certainly shout. But excited to have you. Thank you for joining.
Right. So why the hell are stocks rallying? I mean, we're currently in a global lockdown. People are dying horribly. Demand is on the floor. Manufacturing's on the floor, and really, you'd expect that people want to be out of risk assets, right? You'd expect that stocks should really have crashed further. But for the last 10 years, markets have not necessarily behaved according to fundamentals, the fundamentals that you would expect. And they're totally addicted to liquidity. But something very specific about central bank policy and central bank stimulus, which really causes US equities to rally unbelievably hard when it's introduced. Now, in this chart on the left, let me full screen it. One sec. In this chart, what I've done is I have overlaid NASDAQ E-mini futures with the federal funds rate. Okay. Now, the federal funds rate is in blue and the NASDAQ naturally in white. And essentially what's happened here is that when the Fed have cut to zero, okay, something called equity risk premium compression has happened. And essentially what that is that it's the difference between investing in a risk-free asset like US Treasuries, okay, and investing in higher risk assets like stocks, higher beta assets, okay. Naturally, Treasuries are gilt-edged, so you're pretty unlikely to have a default on them. So people have held them for income. And in risk-off environments, people tend to move to Treasuries even more. But as the Fed have lowered the interest rate, federal funds target range, to 0 to 25 basis points, this risk premium has decreased. So what's happened is that equities have essentially become the safe haven. They've lost their risk element to them. And now this is why you're seeing this massive rally straight off of where the Fed have lowered to 0 to 25 basis points. And I mean, because of this liquidity addiction, you've got to start asking, well, are we just dominated by central bank policy? Personally, I think we definitely are at the moment, but we've got to start asking questions as to, you know, what can break this kind of relationship between central bank liquidity provisions and stock markets, okay? Because we've not seen it yet. We would have expected maybe the COVID crisis to have sent the market lower, but it's just not happened. Over the last few weeks, we've heard of this being a real bear market rally, but I mean, the NQ is nearly back at all-time highs. You know, the high is just up here at 97.69 spot 25. So what could cause this decoupling? Well, yesterday I noted that delinquencies on credit cards and auto loan payments are up by approximately 600%. Okay, and this is something I was mentioning to Macrodesiacs back in March. When you can't fulfill a payment to a creditor, you don't go to them straight away and say, look, I can't pay, here I'm defaulting. You say to them, look, can we work something out? Can I have a bit of a holiday? Things like this. So this is possibly one of the reasons why all of the talk about people not having money and not being able to pay their bills is premature or has been premature. Normally you have a 90-day period of defaults. Now, I saw this article yesterday. Oh, sorry, let me just refresh it to see if I can grab this headline. So Santander's subprime auto loan arm agrees to a $550 million settlement. Okay, and that coincided with the report about the credit card and auto loan delinquencies. Now, I personally believe, and I went on to TRT World, which is a Turkish broadcasting company, basically the equivalent of the BBC. And I said that the economy is purely driven by the consumer, okay? If the consumer doesn't have any money to be able to pay businesses, to buy things, to push up, you know, GDP and to push up demand, then we get into a real conundrum. And the problem that I see going forward is that the markets have kind of recognized this as being a problem, but it's not actually happened yet, purely because of the reasons that I stated previously with regards to defaults taking a longer period to come through. But now I am considering the aspect that possibly in midsummer, this is when we'll start seeing the real tidal wave. Okay, we might tap this high up here. And with the NASDAQ, naturally, it's dominated by tech stocks, information technology. So this is why it's so heavy to the upside. All of that stimulus has pumped into high cap tech equities. So this is why the NASDAQ, even over the S&P 500, has experienced even greater growth since the low. So one thing that I'm looking at kind of taking this macro view over and extrapolating it to a trade idea is looking at Capital One, because Capital One are the largest, they have the largest exposure to consumer debt in the whole of the United States. Now, with a headline like the one that I saw yesterday, and the fact that Capital One hasn't followed through to the upside, like the Nasdaq and like the S&P 500 has, pretty much all of the US equities, tells me quite a lot. Now, why might this be? Well, there's something called net interest margin, and that's how financial firms and banks specifically make their money. It's the difference between essentially the rate at which they receive deposits and the amount that they lend out, pretty much. It's purely how they make money. And I think Trump should be very, very careful with wanting to force negative rates. And sorry, let me just go back to Capital One. You can probably identify a little head and shoulders pattern here. Run away up there, and then maybe this is a right shoulder forming, which could give us a good short opportunity, and that's exactly what I'm looking for. But Trump should be very, very careful with negative rates. If he looks at European banks, which I'll bring up now, stock banks. So this is the stocks bank index. Okay. Now Europe have naturally had negative rates for a very long time. And you can see post 2007, 2008, how far European banks have fallen in their strength. Okay. Now, if we compare that with the US banking index, okay, US banking index looks like is kind of taking the same fate, because if we then take the high of 2007, look, even though banks have been making profits, it's not breached that high. And now look, it's not carried up and followed the broader equities rally. And that tells me that exactly what I just explained, that banks who are facing lower interest rates are unable to make as much money. And that is a big problem for another component, which is core equity tier 1 capital. Okay. Because if people start shorting banks off of the basis that they believe them not to be as profitable under a low rate environment, then what happens to that core equity tier 1 capital? And this core equity tier 1 capital is essentially a measure that regulators use to look at the strength of banks. Now, if they start shorting banks, then that core equity tier 1 capital starts to decrease. Okay, and what does that mean? It means less liquidity, less ability to originate loans, and then less demand and less liquidity in the economy overall. Because at the end of the day, economies are functioned via expanding debt, as we've seen over the last 40 years. And this is really, really something to focus on, and as I said, something that Trump should be really afraid of in terms of coming up to this election and the push for negative rates. And with regards to the election as well, I think there is a double-sided coin here where people are very complacent that Trump is going to win. I think it's the same complacency that has crept in with regards to Brexit, for example, and people thinking that a Remain vote was totally assured. And I think he should be very afraid, as should Wall Street, with the prospect of Biden coming in. I don't think he's as centre as people believe. I think the Overton window in politics has shifted dramatically with Bernie Sanders, Jeremy Corbyn, etc., really going hard left. And the centre right is almost like a centre left now. But just another trade idea alongside the Capital One trade that I just mentioned, and that'll be something that I'll be looking to really fine tune and see an adequate entry on over the next couple of weeks in Macrodesiac. But I just wanted to look at oil as well, because naturally over the last couple of weeks we've seen a pretty harsh environment for oil. Sorry, 1 second. Let me just get the right chart up. That's not the right chart. Okay, we'll just look at it on the other screen, that's fine. So here, I have created a calendar strip of different oil futures contracts from NYMEX, and we can see that they're trading quite orderly. We're trading 34.16 on the July. We're trading 34.59 on the August, 34.99 on the September, and 34.98, well, which is pretty much exactly the same on the October, 35.17 on the November, and 35.44 on the December. If we look back to previous months and when the oil crash actually happened, we can see how disorderly it became. So the oil crash happened here. I've not displayed the front month future, so I haven't displayed the May or the June, purely because it was a total mess. But we're trading in a much more orderly market now. Now, oil is very much demand based. Okay, so as demand starts to pick up, oil should take a bid. Oil should push up to the upside. And now, if you want to take a macro case for this, as the lockdowns globally are lifted, then oil demand should start to spike again. Now, which currency pairs are most correlated to a positive and negative move in oil? That is USD CAD. So America is naturally a massive oil producer, as is Canada. And so when oil rallies, the dollar tends to fall. And when oil rallies, the CAD tends to get stronger. Okay, there tends to be more inflows into Canada, and yeah, the currency appreciates. But what I'm looking at here is something else. So it's kind of a double-sided coin to do with the dollar and the CAD. Okay, so there's something known as the dollar smile, and I'll get to some technical analysis here as well. Actually, I'm not predominantly a technical analyst. I tend to look at the macro picture first to derive direction, and then maybe fine tune back down onto technicals. But this is a fantastic thing occurring here for me. So this is called 3 drives. Okay, so you have a strong support level. You have a strong support level where price comes down and touches each time. And then a drive off, and then it makes a lower high, collapses, another drive off, makes a lower high. And people tend to think that a multiple touch of support means it's a strong support. I don't take that view whatsoever. I find it to be a really weak support because it's showing you where price really wants to get below. Okay, but if we go back to the dollar smile, okay, let me just get a nice picture up for you, just so it's easy to explain. So the dollar smile is essentially this. Dollar strengthens due to risk aversion. So the dollar is considered a safe haven under certain conditions alongside the yen and Swiss franc. And then it gradually moves and changes as the kind of context of the global economy changes. Okay. So we are currently about here, right? We're currently here. Now, I personally think that there should be another bit added here, which is, and this might be it actually, this is probably a better one, okay? So now we're getting kind of skepticism about a global recession. We've already priced in recession, okay? So we should really see a bit of dollar weakness, and while the demand starts to pick up and lockdowns are lifted, we should see the dollar weaken. But then there's the other side of the CAD trade, where, you know, as demand does pick up, the Canadian dollar starts to increase in price. And obviously, I've considered oil as a proxy for demand there, because naturally it is. It really, really is in this situation. And because demand is on the floor, I feel like it's so priced in that any kind of lockdown increase is really going to boost that demand and boost the price of firstly oil, and then as a result of that, CAD. So this is where I've got the direction for in this trade. Now, we can look for a potential target as well. And that target would be, if I can get my drawing tool up. Yes, I work at TradingView, but I still get confused at where things are. That target could
This is we're all looking at a free lesson in how to use TradingView at the same time. This is great.
But a target for this trade, if you look for a break below, a bit of a bid back in, catch some people that want to get long and take the move up there. But a target could be here. So if you were to kind of look at it this way, where I take the brush and then we trade a bit below, trade up, and then all the way back down. That is how I would play a macro trade in this environment. The risk to reward there is excellent. Okay, because you've got all of you've got a two-sided coin in terms of having the correct macro picture on both the dollar and the CAD. Okay, and also, okay, this might be a little trick that you might not know. 69%, I believe, or 65% of IG clients are long dollar CAD. Okay, which would indicate to me that more misinformed traders are on the wrong side. You tend to find that people really need to get ironed out if they're more misinformed, and so that's why I am also extremely bearish if we get a break below here. But I think that's about all that I wanted to talk about with that, and I assume that there'll be some questions now from you, Simon, and I'm more than happy to take questions from the audience as well.
Absolutely, David. Thank you for that. I mean, one, we're having a look at the tools that you've got on the platform for TradingView. I think a lot of us do use TradingView now.
Yeah.
But what you're doing is sort of packaging up. I mean, clearly you've got a very good grasp on the macroeconomic picture, but you're packaging that up for people that perhaps aren't economic trained people, but they do want to have a view on the trading. It's all very well plunging in and looking at the 4-hour and the 5-minute charts and so forth, but what we're becoming aware of is that if you don't understand the big pressures that are moving the markets, then you might not you might get surprises, yeah, and so forth. So it's good to, I think, be this. We do get a lot of people coming on and say, just ignore the fundamentals completely, literally just look at the price action, and that's all you need to do. But
yeah, but I mean,
I think
take this example, okay? So if you were to have ignored the fundamentals on oil a couple of months ago and bought the May contract at $1, for example, thinking that the price was exceptionally low and it was good value, what would have happened? You would have had a massive margin call from your broker. So I don't really buy, sorry to say this, Adam Harris's view that you should ignore the fundamentals, because the fundamentals are where tail risk lies, and tail risk is the thing that will wipe your account out if you're not aware of it. So I think it's naturally it is exogenous and it's hard to measure, but you know, if you're just focusing on price and you're not looking at things that could really be of massive detriment to you, then it's pretty tough to last a long time. And a lot of hedge funds, for example, they purely focus on hedge and tail risk. That is one of their main strategies, because they understand that, you know, if you're running a $1 billion assets under management, or you've got a $1 billion book, for example, you need to maintain those clients and maintain those flows. And if you don't have, you know, adequate tail risk hedging in your portfolio, then those clients aren't going to be with you for much longer.
Charles asks, do you use fundamentals as your trading strategy? I think so. We just covered that. Really, it's central to your trading strategies, really, isn't it?
Yeah, exactly. So fundamentals are how I derive direction in the market. I can't get a read from technicals in the market. I can get a read from technicals as to where's best placed to maybe execute a trade, like here, for example. So I'd look for a run below, a touch, and then push down, purely because that support has been used in the past quite a lot. So I'd expect it to be used as resistance. But it's not necessarily a way in which I would derive a direction. I find that using the the fundamentals of kind of what's going on in the macro picture are a much better read on the market. That's just for me, and I'm not saying it's right, but
sure. So does that mean that timing your trade becomes less important because?
Yeah, that's a very good question. I mean, I can the way that I work with an execution is that I tend to get into really tiny size at the start of the trade, and I kind of let the market comfort me. I let the market kind of massage me into thinking that I'm in the right trade. As it confirms my view more and more via news flow, maybe price as well, that's when I'll start adding size. So that's really how I operate.
Question from Marguerite: how long will it take for the equity market to rally after COVID-19?
The equity market has rallied massively. If you look at the chart, it started rallying back when the Fed committed to stimulus and low interest rates. So the bottom was on the 20th of March. That's US equities. If you look at the FTSE, a little bit of a different picture. The FTSE hasn't actually rallied. This was a funny tweet that someone said because they were trying to compare Philip Schofield coming out as gay to actually moving a market, which was absolutely ridiculous.
Big news events.
Exactly.
Well, the 5G masts could be causing us health problems as well. There seems to be all sorts of strange news and connections being made this year.
Yeah, it was a flippant comment on how anyone can attribute a narrative to whatever they want without actually, understanding what was going on. But if we look at the FTSE, I mean, traditionally the FTSE over the last 20 years has really been used as an income product. So people taking dividends out of the market rather than looking for, big growth in it. And I think if we compare the FTSE to the NASDAQ, for example, we can see a big disparity in how it's reacted once interest rates have gone lower. The NASDAQ's gone way higher, which is showing that US equities have become that safe haven. While the FTSE has kind of languished and even made a lower high here. So yeah, it's a tricky one. However, the FTSE now is at, I think, record levels. It's about 12% on average annual dividends paid out, which if you're an income investor, you're pretty damn chuffed with that because you're not necessarily worrying about price. You're just looking at earnings per share, aren't you? Yeah,
right. Except that recently they're cutting the dividend payments, maybe temporarily.
Yeah,
there's a lot of dividend payments being held back and so forth. So that's not so much fun for people that maybe rely on these payments.
That is true.
I'm sure that's just temporary. Now, Kingsley's saying, can you show us your macrodesiac website? Let's get onto that in a moment.
Sure.
Peter, first of all, it's just saying, does David focus on specific areas? I would think using fundamentals in all the different sectors would need hours of study. Are there correlations between different sectors? Well, I imagine that's something that you can address in as being a macrodesiac. And also, just while I'm putting these questions to you, a trading view question I've just recently discovered asks David, and getting used to it, the TradingView platform that is, have you any advice as where to go on the website for a beginner to this platform to learn their way around it?
Yeah, sure. So there's a whole TradingView wiki. Let me get it up for you. So yeah, if you pretty much type in, okay, so let's type in volume profile. Okay, so then, sorry, where's the correct one? Do you know what I'll do for that question? I'll find it because it's not coming up in Google adequately.
Okay.
Let me try another search. Just one sec. Weird. I'll try and find the correct link for you, and I'll send that across. So that person. Sorry about that.
No, that's absolutely fine. Maybe we can go back to Peter's question, just asking about using the fundamentals and sectors and the hours of study,
Yeah.
the correlations between the sectors.
Yes. So, which specific assets? Because naturally, okay. So let's take this for example. Let's look at gold, as we were talking about in the past. Call or presentation. Sorry. So if we take a look at gold, okay. Now, gold is traditionally an inflation hedge, isn't it? So that's what it's been seen as. Possibly you could also consider it a deflation hedge in this environment, because naturally demand's on the floor, people aren't spending, money velocity isn't going anywhere, but gold's still rallying. So there's two sides there. And then naturally there's the protection against risk. So I like to think of correlations in terms of risk. Okay, and that's pretty much where I start every single thesis that I have when I come to approach a market. So I look at the Aussie yen a lot. So if we compare, say, ADJPY, let's do it actually on this chart. So traditionally, yen is a safe haven because Japan is pretty geopolitically stable. You tend to see yen flows when the markets turn risk off, okay? But if you can look here, so as gold was rallying, Aussie yen started to fall. Now, this also has something to do with the interest rate differentials and the high beta, so the higher volatility of the Aussie compared to other assets, specifically yen. Something comes into it as well to do with carry weighted strategies in certain portfolios where you're earning carry on FX. But you can see a differential here. So gold has rallied as the markets have turned, a bit risk off, and Aussie yen has fallen at the same time. So I always approach the markets from looking at where risk is placed at the moment. So different sectors, I guess you could compare, say, you could do a comparison of even equities here. So you could look at gold, and if we go back to the NASDAQ again, I might be boring you with that asset, but it's a good one. They've converged recently. So if we go back far enough, they've really have converged. And I think the relationship is more on an intraday relationship that you might see gold drop off as risk rallies, okay? But, over this longer term, it's probably been a hedge against central bank risk. But I mean, if you could get more specific there with that question, i.e. which sectors, that would be great, because then I could really delve into what your real question is.
Okay, that's Peter that asked that question. Okay, we'll hear more if there's a particular sectors that we want to look at. Don't the Fed policies trump all other fundamental issues when it comes to equities?
I mean, yeah, at the moment they are. That's what I was talking about with regards to the liquidity addiction and how them going to negative rates, pretty much negative real rates they're at now. If you look at the whole entire yield curve, okay. So US real yield curve. Okay, so the Treasury website's down. Good. There we go. So the real yield curve here, from 5 years out to 30 years, is negative. However, if you look at, say, the US 10-year yield, okay, and this is a proxy for interest rates, we're currently at 0.672%. But when you include inflation, we're already negative. So this is why US equities have taken such a heavy bid, because of that risk premium compression. Okay, it doesn't pay now to be in US Treasuries. You're losing money each year. So people are looking at equities now as the safer option, and that's a massive distortion of risk, because naturally they're not. They're higher beta. Sorry, a helicopter's going over my house, so just one sec.
They found you, David.
Yeah,
They've tracked you down.
I live down near Battersea, and there's a big helipad here. So right, I think it's gone. Okay, so
We can hear you fine.
where was I? Yeah, so it comes back to that equity risk premium compression. And back in, now I'm going to show you a zero hedge page, unfortunately. And this is one of my favorite charts ever. Okay, this is it here. So you can see, so this basically is showing the contribution to S&P 500 rallies and past expansion cycles. In 1983 to 1990, 92% of the rally in the S&P 500 was down to earnings growth. Okay, so companies performing well. In 1996 to 2000, 42%, so leading into the dot-com, was due to equity risk premium compression. 51% was due to earnings. 2003 to 2007, a massive amount was due to earnings. But from 2012 to 2016, when the Fed have had QE and you know, low rate interest rate policy, 92% is due to equity risk premium compression, and that is that the risk of holding equities over US Treasuries or other risk-free instruments has decreased massively, and those distortions are literally. It's the reason why you're constantly seeing rallies on the equity markets, even during bad news. That's all it's down to. It's down to market mechanics and nothing else. At the moment, we're at the largest, you know, PE ever, so price to earnings ratio, and it's got to be untenable, but it hasn't been for the last 10 years. So it's a really, really tricky situation to do with risk distortion we're in. But having said that, you know, if we're traders and we want to make money, you may as well sit on the bid, because it's not going down anytime soon, unless that kind of relationship that I mentioned previously goes, and that was to do with the consumer, and if Main Street actually becomes, you know, important again to markets.
Fascinating. I mean, it has been one of the, it did get everybody's head scratching a few weeks ago when we thought this is, you know, calamity and Armageddon, and yet the markets are going up. It's
Yeah.
The normal person in the street opens the paper and think it's hard to rationalize it, and it is that understanding of what's going on behind. So we're getting some questions about Macrodesiac. We've sort of been talking about the service that you also provide. Clearly, we've been looking at TradingView, and for those of you that, I don't think there's many of us that don't use TradingView or haven't, but it's a free, it's a fantastic platform, just to log in and start analyzing all these different markets and stocks and things like that in there. So you obviously manipulate that extremely well. You've just shown us some of the features as you've been talking. We've all been watching you navigating your way around, so there's lots and lots of tools there. But not only that, you've adding on new features like the streaming service, where we'll hopefully be doing some events in there as well. But you can go on. I've enjoyed watching some of the traders that are coming on a regular basis and streaming some live trades in there as well. So all sorts of good things at TradingView. Macrodesiac, though, could you tell us a little bit more about what you've been doing and how it works, and maybe what you get as a member?
Let me show you the website first. So look, you have to write some sales copy, and I've got this written because, you know, it gets people interested. Okay, it's a bit cheesy, and that's not really me. I'm very fact-based and very kind of to the point. But what you get is it's essentially a tool where you're in a community of other really high quality traders, and it's not necessarily advice. I wouldn't say it's advice. I provide trade ideas, so what I'm thinking and what I convey. So just like with the dollar CAD trade that I mentioned to you, and also the Capital One short trade, these are things that I've discussed in here, and we just recently launched launched an app as well. So this is the web app. The phone app is actually much better. It's on what you call it, App Store and Google Play, so you can download them to your phone. And essentially, it's just a running commentary all day of things that I think are really, really pertinent and things that you can actually take action on. Okay, so here, for example, why does a trade deficit weaken the currency? That's something that I've just commented on and put my thoughts down on, and it's kind of learning via osmosis. So I'm there to answer questions, absolutely, but over time you tend to just grasp onto things and catch on to themes that are occurring, purely because I'm massively interested in them, and I think what I'm saying is kind of a filter to all of the noise that's out there, and maybe things that you should focus on as well. But as I said, the phone app is much broader, and also I send out more detailed investment notes via email. Okay, and they're the ones that really are the things that you can take action on. That's where the trade ideas are, but they get posted in here as well. And sometimes I'll do an update of a day trade, even though I rarely day trade. It's just sometimes the situation forces it, purely because, you know, the market context changes and you have to get more aggressive. But for example, this guy here, he works at a large commodities broker. I shan't say which one, just in case I'm not allowed to. But we've also got another guy in there who's worked for many different brokers, many different trading firms, veteran of the markets for 30 years. And we're just adding more people all the time to really give a nice, well-rounded view of really what's going on, and to cut through all of the noise that's out there, really. But yeah, that's it really. I've created it purely to try and get people who might not necessarily know about macro, but think it's the right thing to focus on. That's really who it's for. But also people that just want to learn and to get some ideas for themselves.
So yeah, it's a filter for quality. The higher quality. You've obviously got a great slide. I saw Redbox there.
Yeah, I've got a partnership with Redbox as well. So you get 30 days free Redbox, which is essentially Bloomberg. It has exactly the same news feed as Bloomberg, but for, you know, 60 quid a month rather than $20,000 a year. So yeah, it has everything that you need to stay on top of things.
I know Charlie and Dave.
Yeah, Charlie's a nice guy.
Helped with some of the webinars as well in the past. So fantastic. Can we go back? Peter just said, "Oh, he said I was really trying to determine if one particular sector was strong. Is there a sector which reacts in the opposite direction? I seem to remember an RTC session about wave theory, and depending on where we were in the wave, certain sectors would do well and others not." So that's fine, Peter. Yes, I think that's cleared us up. So any insight into if one sector is doing something, does that trigger something in your head, David, to say, well, I should look at this or I should look at that because that diverging? Or
yeah, so I mean, you've got defensive plays where stocks tend to rotate. Okay, so let's take pharmaceutical stocks. They tend to become a very defensive play. I can't remember the pharma stock ETF. One sec. So let's have a look. PJP, that's it. PJP. So I believe it was, yeah, so just before Christmas, we became a little bit defensive and people started to rotate out of, you know, a bit of tech, out of certain financial stocks or ETFs like XLF, and they rotated into pharmaceuticals. I guess you could consider it just a rebalance because, you know, we've had all of this move down and then they just wanted to rebalance their portfolios and buy some undervalued stuff, and then kind of converge back to the mean, because actually that's what, 50% there. Oh, wrong one, but that's about halfway through. So yeah, it's kind of a mean convergence. But yeah, different sectors definitely do have different behaviours under different market contexts. Defensive stocks, so arms companies. So if you take Lockheed Martin, you know, you see similar things happen here. So around Christmas time, again back in 2018, we saw a rally up, and it does tend to happen just before Christmas. Actually, I think it might be due to people wanting to take on a bit less risk going into the Christmas period. Q1 tends to be a little bit hectic for many. So, you know, it gets bought here, and then they might just play a trend rally. If it reverts, they get out maybe somewhere here like this low. But yeah, there are certainly different rotations out of sectors based on whether people believe it's overvalued or undervalued, and obviously the market context. Does that answer it?
Sorry, I had myself muted there. Thank you. Yes, I think that, Peter, hopefully that gives you a little bit more insight to that. Thank you, Dave, says Marguerite. Very interesting changes to the earnings, the ERP compression through the last years. Absolutely. Yes, thanks, says Peter. That's great. Thanks, says William as well. So fantastic. I feel like I've had two presentations in one here. You've given us a bit of a technical analysis overview, just quickly looking at the charts, seeing you jumping around the platform is fantastic to that. So
I'm more than happy to do this whenever people want, because naturally you can probably hear that I really love this stuff. And I guess there was no presentation, it was just off the top of my head. So if you want more, I'm available, Simon.
Thank you, David. That's I think we'll be careful what you offer, because we'll take it. It's been great. It really has been great. This is right on the money for where we like to sort of send to these presentations. We obviously do have slideshows and PowerPoints, but everybody's ears pick up as soon as we move on to the live charts and the platforms. And I think you've done a great job for us. Thank you. Kingsley says, did you read Trade What You See?
Did I read Trade What You See?
Trade What You See. Not one.
Is that a book? I've not heard of that.
I haven't come across that. Kingsley, what is who wrote that? Or maybe it's something that we should all have a look at.
Sorry, I forgot to get the chat up. I'm just listening to you relay it.
That's fine. Oh God, Larry Pesavento, my old friend Larry, of course. Now we have Larry on from time to time. He hasn't done one recently. I must phone him up though, and see if he'll come and join us. I've recorded one of his presentations. It's on that 10 essential lessons course that I've got on the Round the Clock Trader website. But we'll try and get Larry back for something else in the future.
One last thing. I just wanted to mention why I use black and white as well. I tend to find that green and red create an inherent bias in your emotions. Okay, so people see green and think, oh, it's bullish, when actually it's not dictating bullish. It's just, you know, it's literally just something flashing off in your head. So black and white with bars, not candles, that's what I use, purely to become as objective as possible.
That's a really interesting point. And I think you're right. I think you're right. You do look for these signs sometimes. The color, more green bars, it's not necessarily giving you the whole picture.
Yeah.
So obviously you can set up TradingView into any configuration that you want, any background color and so forth. Quite easy to do all that. Just a final question. David is saying if David could remember to send the link to TradingView charts overview.
Yes.
This was thank you for the reminder. Just where to go to get started with TradingView. I mean, I think like most things, it's free to access, and the more you just spend time on the platform, you will intuitively get to understand the features of it.
That's it. No, absolutely. So
This
here
is,
we go. So, yeah, so this is the new one. It looked different before, that's why I got confused. But let me drop it into the chat. So here we go. There we go. So literally, if you just use that search bar like I did, and you can search for pretty much anything that you need, it will pull it up. And it's literally like a Wikipedia page almost, or at least it was. So that's why I was referring to it as the TradingView wiki.
yeah, so tradingview.com/support, and you've got all that sort of stuff going on there. Fantastic. Left color all the time. Black and white is the best to reduce brain overload. Philip, they're agreeing with you on the color setup of the charts. Any final questions before we let David go? But I really enjoyed that, David. Thanks for that. I appreciate you taking the time to join us and come on. And good luck with Macrodesiac as well. I think it's an important service that you're building up. I can imagine that will be quite an exclusive community of like-minded traders. This is what we've got to do. We've got to help each other, and it's amazing. Just one little posting can sometimes put you onto something that you might not otherwise have seen. And of course, coming onto these webinars as well, a lot of people have told me that they find it useful, not necessarily because they're learning new stuff all the time, but sometimes it's what's talked about in between the slides that's that can make the difference.
Little things can trigger off ideas.
And it is a fascinating time to be around as a trader at the moment, an investor. It's nerve-wracking, but fascinating. Sorry, David, you used 3 drives, which is in Larry's book. Oh, this is Kingsley again, so maybe.
I had no idea it was from Larry's book. I think I must have picked it up or tested it a few times. I didn't know it was by him. But yeah, it's probably just something that I've heard about over the years, and it's kind of fit my macro view on that trade, which just adds probability, you know.
Great. Well, if anybody wants to go and do some of Larry Pesavento, as I say, go on the website. 10 essential lessons. Just it's free to access, and there's a great presentation in there from Larry Pesavento. Fantastic. Well, David, thank you so much for joining us. I think we'll wrap it up there. We've really enjoyed that. As I say, we've got hopefully some events that we're going to try and stream through with TradingView, so we can output some of these events to the community through the streaming function that's there. So we'll get working on that. And hopefully you can come and join us again. We've got some other events coming up, some online summits and things like that I'd like to speak to you about. But good luck with Macrodesiac.
Thank you, mate.
We will email out the link to everybody on the database so they can hopefully come and have a look. Is there a trial period or anything to people to come in and have a test and see what it's like, or how does that work?
Yeah. So the way that I have worked it, so I was doing a free trial, but I noticed that the quality dropped. Okay, people were coming in and it just wasn't conducive to the environment that I wanted. So I've now done a $9.99 for the first month, offer, purely to ensure that there is a barrier to quality and to make sure that people who really kind of do want to learn and be a part of it come in. So that's why I've put it up to $9.99 for the first month. It's normally 40 quid a month, which is a tenner a week, 2 quid a day roughly. I think it's reasonable for the community and what you get out of it.
Absolutely, and I understand the strategy as well. We used to do that. I used to work with VectorVest, and yeah, they trials, doing free trials sometimes, they got overloaded with thousands of people that weren't seriously, and people didn't spend the time to get to know the program in that trial period because it was free. So just a little deposit to invest to let you know that you're serious, and everybody can afford $9.99, I think, for a month. Otherwise, we shouldn't be trading at all. So good luck. Good luck with all that. I'll take the presenter role back, and really thank you again for taking the time to join us today, David, and we'll keep in touch, and hopefully look forward to hearing from you again.
Definitely. Thanks for having me.
So there we go. So three fantastic speakers that we've had today. My thanks to them all, Adam Harris, Fred Brett and David Bell, we've just been listening to. So that brings us rather neatly to the end of our working lunch, 5 to 2. So we'll wrap it up there. Thank you everybody for joining me, and as always, the recordings will be available on the Facebook page and the website roundtheclocktrade.com, and of course we've got some other stuff coming up next week, and also some new online summits and things like that are coming down towards us at the end of June as well. So it's going to be good fun. Keeping in touch. As always, let me know where we can improve further, and what else we can do. If you have any speakers you think I should be talking to, please do let me know, and I'll be happy to make contact with them, hopefully get them on for a webinar. So there we are. Thank you very much, and thank you to all our speakers. Have a nice day.